Good morning everyone, this is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 10th of August. RBNZ to pull the trigger, but will it be enough to weaken the Kiwi? During the Asian morning Thursday, all lights will follow on the RBNZ monetary policy decision. The forecast is for the Reserve Bank to reduce its benchmark interest rate by 25 basis points to 2%. Market participants are certain that the rate cut will take place with 100% implicit probability for such a move. The probability skyrocketed in late July after the RBNZ's brief update of its economic assessment showed that further policy easing will likely be required, mainly because of the trade-weighted exchange rate being higher than assumed in June. The higher exchange rate holds down tradable goods inflation, making it more difficult for inflation to rise towards its target range. In addition, the nation's inflation rate remained unchanged at 0.4% year-over-year in the second quarter, while the bank's updated two-year inflation expectations barely budged to 1.65% from 1.64% the previous quarter, which is still below the midpoint of the bank's target range of 1 to 3%. In our view, this data suggests that inflationary pressures remain subdued and enhance the case for policymakers to pull the easing trigger as early as at this gathering. The bank was reluctant to cut rates at its last two meetings, as lower rates could have inflated even further the nation's elevated home prices, thereby risking financial stability. That obstacle is now gone, with Governor Wheeler announcing plans to tighten restrictions on home lending, something that is expected to curb house price inflation. We therefore believe that in addition to a rate cut, RBNZ officials are likely to include a clear easing bias in the meeting statement, signaling that further stimulus may be appropriate in coming months. Even though a 25 basis points rate reduction is already fully priced in, we believe that such strong signals for further easing could bring the Kiwi under renewed selling interest, at least temporarily. On a longer-term perspective, though, even if the meeting statement indeed suggests that more cuts are on the way and Kiwi drops as a result, the currency's downside may be limited, considering that the RBNZ still offers the highest rates among the G10s. In a world of negative yields and heightened political risks, a combination of higher bond yields and a very stable political environment in New Zealand could keep the Kiwi in demand. As for today, during the European day, Norway's CPI data for July are due out. Both the headline and the core CPI rates are forecast to have ticked up and to remain well above the Norges Bank target of 2.5% year-over-year. Interestingly, in its June monetary policy report forecasts, the bank assumed that it would cut rates by another 25 basis points until the end of the year. We believe that further acceleration in inflation could generate doubts on whether the bank will indeed opt to cut rates again. As a result, this could support NOK. From the US, we get the job opening and labor turnover survey report for June, and expectations are for a rise in the number of job openings. Nevertheless, following June's astonishing employment gains, we doubt that a modest increase in JOLTS is going to come as a surprise to market participants, and thus the reaction in the dollar may remain limited. We have no speakers scheduled on today's agenda. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.